As of today, while I'm recording this, gold is trading right around 2040 in the Western spot market, fluctuating within a tight band as liquidity thins into the session close. Silver is sitting near 2320 after that plunge, having wicked slightly lower intraday before stabilizing. That's the reality. Those are the numbers. That's where price is. Now the only thing that matters is what this data is actually telling us and what to expect from it. In the last breakdown, I told you levels matter more than headlines. I told you the market doesn't move because of news. News moves because of positioning. And positioning was stretched. Gold had been grinding higher into resistance. Silver had been lagging but holding key structure. And then suddenly, in one session, both get slammed together. That's not coincidence. That's a coordinated test of support. That's the market asking one question. Who's actually committed here, and who's just renting the trade? And let's be clear about something immediately. This is not a signal. This is not telling you what to buy or sell. This is tape reading. This is data interpretation. This is watching how price reacts around key levels and letting the market reveal its own structure. Because without structure, without levels, without volume confirmation, all you have is noise. And most people are trading noise. Now here's the development the mainstream won't cover. While Western headlines are talking about profit-taking and strong dollar pressure, the actual mechanics underneath this move tell a different story. Overnight liquidity was thin. Futures volume spiked during off-hour sessions where price impact per contract is amplified. That's where the initial push lower began. Then New York opened, and instead of a recovery, we got continuation. That tells you this wasn't just an overnight wobble. This was an intentional pressure move carried through into peak liquidity hours. If you're actually learning something here, if you're actually watching the data and not just scrolling past charts on social media, comment OG below. Just those two letters. It tells me who's paying attention and who's just here for dopamine. Because this market punishes the second group first. Current numbers as of today. Gold spot roughly 2040. Futures hovering within a few dollars of that depending on the contract month. Silver spot around 2320 after touching lower intraday levels before stabilizing. Dollar index firm, but not exploding. Yields mixed. Equity markets showing mild stress but not full panic. That combination matters because metals don't move in isolation. They move inside a web of liquidity conditions. And today's move suggests liquidity stress more than macro certainty. Now let's talk about structure. Because without structure, you're blind. Gold had support layered around the 2035 to 2020 zone. That's the first band where buyers historically stepped in over the last several weeks. We tagged the upper edge of that band today. We didn't fully break it yet, but we tested it. Silver had support around the 23 level, with deeper support closer to 2260. Today's drop brought price right into that zone, not below it decisively, into it. That distinction matters. Tests are not breaks. Flushes are not always reversals, but they often precede them. Here's what matters about a flush. A real flush is violent, fast, and accompanied by volume expansion and open interest contraction. That's what you watch. Because if price drops, but open interest drops with it, that means positions are getting closed, weak hands leaving. If price drops and open interest rises, that means new shorts entering. That's a different dynamic. Today we saw a mix. Some liquidation, some fresh short pressure, but not a full capitulation event, which means this may be the beginning of a flush rather than the end of one. People keep asking, is this the bottom? That's the wrong question. The right question is, what does the data say about positioning now versus yesterday? Because price is just the surface. Underneath that surface, you have futures positioning, ETF flows, vault inventories, and physical premiums. That's where truth lives. Let's start with futures. Open interest on major gold and silver contracts did decline slightly into the drop, suggesting some longs were forced out, but not massively. Not enough to call this a complete washout. That means there's still positioning left to shake if pressure continues. However, we also saw signs of short-term shorts covering into the lows. That's important, because when shorts cover into a drop, it often creates a temporary floor. Now let's talk about physical demand, because while paper price can move fast, physical demand moves slow but steady. Premiums in key physical markets didn't collapse with this price drop. They held relatively stable. That tells you physical buyers didn't panic. They didn't suddenly flood the market with sell orders. They waited. They absorbed. That divergence between paper price and physical behavior is something you always watch during flushes. And here's the macro layer. Dollar strength has been cited as the reason for this move. But the dollar didn't explode higher today. It moved, yes, but not violently. Yields didn't spike dramatically either. That means the metals drop was not purely macro-driven. It was positioning-driven, liquidity-driven, possibly even options-driven as certain strike levels came into play and forced hedging flows. When you see metals drop harder than the macro backdrop would justify, that's usually a positioning event. Someone wanted price lower, someone needed price lower, or someone took advantage of thin liquidity to push price lower. That doesn't automatically mean manipulation. It means structure. It means order flow. It means large players operating inside a market that isn't as deep as people think. Now, let's talk about what to expect from this data. If gold holds above that 2020 to 2035 support band and stabilizes, this drop becomes a shakeout within an uptrend. If it breaks decisively below that band with volume, then we look lower, toward the 2000 psychological level and possibly into the 1980 zone where deeper support sits. For silver, if 23 holds, we can see consolidation and potential recovery toward the mid-24 range. If 23 breaks cleanly, then 2260 and even 22 become the next magnets. This isn't prediction. This is conditional analysis. If this, then that. That's how disciplined traders think. They don't guess, they observe, they react. Now, here's where things get interesting. Because while the paper price dropped sharply today, ETF outflows were not massive. Not yet. That means holders didn't rush for the exits en masse. When price drops hard but ETF outflows remain limited, it suggests investors are either complacent or confident. Either way, it means the flush hasn't fully achieved maximum panic, which means volatility could continue. At the same time, central bank demand for gold globally has not disappeared. That structural bid underneath the market still exists. That doesn't prevent short-term drops, but it does create longer-term floors. And when short-term positioning collides with long-term demand, you get volatility spikes like today. Let's connect this to broader liquidity. Equity markets have shown signs of stress. Credit spreads have widened slightly. Nothing catastrophic, but enough to suggest liquidity isn't as abundant as it was. When liquidity tightens, leveraged positions across markets get trimmed. Metals are not immune to that. In fact, they often get sold alongside everything else during liquidity squeezes. Not because fundamentals changed, but because cash is king in the short term. So was today the big flush? Maybe, maybe not. The data so far suggests partial flush, not full capitulation. We saw a sharp drop, but we didn't see extreme volume spikes across all venues. We saw some liquidation, but not mass panic. We saw price hit support, but not decisively break it. That combination suggests this move could extend or consolidate before a clearer direction emerges. What you watch now is simple. Watch how gold behaves around 2040. Watch if buyers step in around 2020. Watch if silver holds 23. Watch volume on any further drops. Watch open interest changes. Watch ETF flows over the next few sessions. Watch dollar and yield behavior around upcoming macro data releases. Because the next catalyst could either accelerate this flush or reverse it. And remember, the market doesn't reward impatience. It rewards observation. The people who survive volatility are the ones who wait for confirmation, who wait for structure, who let price show its hand before committing. As of today, the numbers are clear. Gold around 2040, silver around 2320, sharp drops on the day, support zones being tested, positioning being shaken, liquidity being probed. The next move will depend on how these levels respond to continued pressure or relief. That's the data. That's what matters. Everything else is noise. What matters now is how price behaves after the first shock. Because the first move down is rarely the full story. The first move down is the test. The second move tells you whether the market accepted those lower prices or rejected them. And right now, based on the data we have as of today, the market hasn't fully accepted lower prices yet. It probed them. It tested them. But it hasn't confirmed them. Gold sitting around 2040 after a $32 drop is not a collapse. Silver around 2320 after a $+ flush is not a breakdown. It's pressure. It's a squeeze. It's a test of commitment. And the next sessions will tell you if that test turns into a full liquidation cycle or if this was the big shake designed to clear weak hands before stabilization. Let's go deeper into the mechanics, because people keep asking what to expect from the data, not the headlines. When gold drops sharply but remains above major weekly support, you look at follow-through. If follow-through selling appears in the next session with rising volume, that suggests the flush isn't over. If follow-through selling fails and price stabilizes, that suggests the initial drop did its job. Today's drop pushed price into a zone where buyers historically stepped in. That zone hasn't been fully violated yet. That matters. Because markets don't usually reverse without testing levels multiple times. They probe, they revisit, they shake. Then they decide. Silver is even more sensitive to these moves because it carries both monetary and industrial demand characteristics. When silver drops faster than gold, that's usually a sign of risk-off positioning or leveraged long liquidation. Today we saw that. A sharper percentage drop in silver than gold. That ratio move matters. It suggests speculative positioning in silver was more crowded and therefore more vulnerable to forced exits. But again, the key question is whether that forced exit phase has completed or is still unfolding. Look at intraday structure. Silver flushed quickly, then stabilized. That stabilization is not confirmation of a bottom, but it is confirmation that buyers exist in that zone. If those buyers get overwhelmed in the next sessions, then you get continuation lower. If they hold, then you get range formation. Range formation after a sharp drop often becomes the base for the next move, whether that move is up or down. So the expectation from the data right now is not an immediate V-shaped recovery. The expectation is volatility and testing. Markets like to test levels repeatedly before choosing direction. Now let's talk about positioning again, because positioning drives short-term moves more than fundamentals. The drop today forced some leveraged longs out of the market. We know that because open interest declined slightly into the move, but not dramatically. That means there are still longs left who could be forced out if price drops further. At the same time, shorts entered into the drop, but not aggressively enough to suggest full conviction. That creates a situation where both sides are somewhat exposed. That's where volatility thrives. When both longs and shorts are uncertain, price can swing rapidly between levels. ETF flows provide another piece of data. When price drops hard and ETF outflows remain modest, it suggests longer-term holders are not panicking. That reduces the probability of a sustained collapse. But if ETF outflows accelerate in the next sessions, then the flush deepens. So watch those numbers closely. Because ETF flows often lag price by a day or two, the real reaction sometimes shows up after the initial drop. Physical demand data is slower, but equally important. Premiums in physical markets haven't collapsed alongside paper price. That suggests physical buyers are still active. They didn't suddenly disappear. That doesn't guarantee price will rise immediately, but it does create a floor underneath the market. When paper price drops into strong physical demand zones, it often finds support sooner rather than later. Now let's zoom out to the macro context. The dollar remains relatively firm, but not explosive. Yields are elevated, but not spiking. That combination creates pressure on metals, but not catastrophic pressure. If the dollar were surging and yields were skyrocketing, you'd expect a deeper metals sell-off. The fact that metals dropped sharply without a corresponding macro shock suggests the move was more about positioning than macro fundamentals. That means the move can reverse faster than a macro-driven decline would. However, we can't ignore the possibility that macro catalysts could amplify this move. Upcoming inflation data, central bank commentary, and economic reports could all influence the dollar and yields. If those data points come in stronger than expected, they could add pressure to metals and extend the flush. If they come in weaker, they could support a rebound. So the expectation from the data is conditional. Metals are now in a sensitive zone where macro surprises can have outsized effects. Let's talk about liquidity. Liquidity conditions across markets have been tightening slightly. Not dramatically, but enough to matter. When liquidity tightens, leveraged positions get trimmed. That affects all asset classes, including metals. Today's move could be part of a broader liquidity adjustment. If equity markets experience further stress and credit spreads widen, metals could see additional pressure as investors raise cash. But once that cash-raising phase ends, metals often recover as safe haven demand returns. So watch broader market behavior. Metals don't exist in isolation. Another factor is options positioning. Large options expirations around certain price levels can create hedging flows that push price toward those levels. If there were significant option strikes around the levels we hit today, that could have contributed to the move. Once those options expire, the pressure often eases. So the expectation is that volatility could remain elevated until those hedging flows subside. Now let's address the psychology of the market. Sharp drops create fear. Fear creates selling. But not all selling is equal. Some selling is panic. Some selling is strategic. Some selling is forced by margin requirements. Today's move likely included all three. But the absence of massive volume spikes suggests it wasn't pure panic. It was more controlled, more strategic. That means the market hasn't reached maximum fear yet, and markets often bottom when fear peaks. So what do we expect from the data going forward? First, watch whether gold holds above 2020. If it does, expect consolidation between roughly 2020 and 2080. If it breaks below 2020 with conviction, expect a move toward 2000 and possibly 1980. For silver, watch 23. If it holds, expect consolidation between 23 and 2450. If it breaks below 23 decisively, expect a move toward 2260 and possibly 22. Those are the key zones. Those are the levels the market is watching. Also watch the gold-silver ratio. It widened during the drop, which is typical during risk-off moves. If the ratio starts narrowing again, that suggests silver stabilizing relative to gold, which often precedes a broader metals recovery. If the ratio continues widening, that suggests continued stress in silver and potentially more downside. Let's bring this back to today's numbers again so there's no confusion. As of today, gold is around 2040, silver around 2320. Sharp drops on the day. Support zones being tested. Positioning partially shaken but not fully flushed. That's the reality. That's the data. Everything else is interpretation. The market will now do one of three things. It will continue lower, testing deeper support and completing a full flush. It will stabilize and form a range, digesting the move before choosing direction. Or it will reverse quickly if buyers step in aggressively. The data right now suggests scenario 2 is most likely in the immediate term, stabilization and testing. But that can change quickly if new information hits. This is why discipline matters. Because reacting emotionally to a single day's move is how people get trapped. The professionals watch levels. They watch volume. They watch positioning. They wait for confirmation. They don't assume. They observe. So what do you expect from the data next? Expect volatility. Expect tests of support. Expect headlines to exaggerate the move. Expect social media to call for crashes and rallies simultaneously. But rely on the numbers. Gold 2040. Silver 2320. Support zones just below. Resistance zones just above. Watch how price behaves around those levels. That will tell you whether this was the big flush or just the opening act. What you watch now is simple. Watch how gold behaves around 2040. Watch if buyers step in around 2020. Watch if silver holds 23. Watch volume on any further drops. Watch open interest changes. Watch ETF flows over the next few sessions. Watch dollar and yield behavior around upcoming macro data releases. Because the next catalyst could either accelerate this flush or reverse it. And remember, the market doesn't reward impatience. It rewards observation. The people who survive volatility are the ones who wait for confirmation, who wait for structure, who let price show its hand before committing. As of today, the numbers are clear. Gold around 2040, silver around 2320, sharp drops on the day, support zones being tested, positioning being shaken, liquidity being probed. The next move will depend on how these levels respond to continued pressure or relief. That's the data. That's what matters. Everything else is noise. Now we get to the part most people miss, because after the initial shock and the first stabilization phase, the market enters what I call the confirmation window. This is the period where the market decides whether that drop you just saw was a one-day liquidation event or the beginning of a broader repositioning cycle. And as of today, based on the data we have, we are inside that window. Gold is still hovering around 2040. Silver is still sitting near 2320 after the plunge. Those numbers matter because they anchor everything else we're about to talk about. If price starts drifting lower from here without strong buying responses, that tells you the flush isn't done. If price stabilizes and starts grinding sideways with decreasing volatility, that tells you the flush likely did what it needed to do. Let's start with volume behavior after a drop like this, because volume is the truth detector. When you see a sharp decline followed by low volume sideways movement, that often means sellers exhausted themselves temporarily. They pushed price lower, they triggered stops, they forced liquidations, and then they stepped back. Now the market waits to see if new sellers show up. If they don't, price stabilizes. If they do, price continues down. So far, volume after the initial drop has not exploded. It's been moderate. That leans towards stabilization rather than immediate continuation. But we're not out of danger yet, because continuation often comes after a pause, not immediately. Open interest tells a similar story. We saw some contraction during the drop, meaning some longs were forced out. But we didn't see a massive wipeout of positioning. That's important, because if positioning remains elevated, the market still has fuel for further downside if pressure returns. Think of it like dry wood in a forest. The first fire burns some of it, but not all of it. There's still material left if sparks fly again. And those sparks can come from macro data, dollar moves, or simply large players deciding to push price into deeper liquidity pockets. Let's talk about the dollar again, because people always jump straight to the dollar as the reason metals move. The dollar did strengthen slightly during this drop, but not enough to justify the magnitude of the move in silver especially. That tells you the metals move had its own internal drivers. Positioning, liquidity, and technical levels mattered more than macro headlines. However, if the dollar continues strengthening over the next few sessions, that could add pressure to metals and push them into deeper support zones. If the dollar weakens, metals could find relief quickly. So the expectation from the data is conditional on how the dollar behaves from here. Yields are another factor. Real yields rising tends to pressure gold, but today's yield moves were not dramatic. That again suggests this was more of a positioning flush than a macro repricing. However, yields don't need to spike dramatically to influence metals. Even small moves can matter if positioning is crowded. So watch real yields closely. If they start creeping higher, that could keep pressure on gold and silver. If they stabilize or fall, that could support a rebound. Now let's bring in the broader market context, because metals often move in sync with or in response to other asset classes. Equity markets showed mild weakness during the metals drop. Not a crash, but enough to indicate some risk-off sentiment. Credit spreads widened slightly. Again, not dramatically, but enough to suggest liquidity isn't abundant. When liquidity tightens across markets, leveraged positions get trimmed. Metals often get sold during those trimming phases because they're liquid and easy to exit. But once that trimming phase ends, metals can recover quickly. So the expectation is that if broader markets stabilize, metals could stabilize too. Another piece of data to watch is the gold-silver ratio. It widened during the drop, which is typical when silver gets hit harder. If that ratio starts narrowing again, that suggests silver stabilizing relative to gold. That's often a sign that the worst of the flush is over. If the ratio continues widening, that suggests ongoing stress in silver and potentially more downside. As of today, the ratio moved higher during the drop but hasn't exploded. That suggests stress, but not panic. Let's talk about technical structure in more detail, because structure is what traders actually trade. Gold's immediate support remains around 2020 to 2000. That's the zone where buyers previously stepped in. If price drifts into that zone and holds, you get a base. If it breaks decisively below that zone with volume, you get continuation lower. Silver's immediate support is around 23 and then 2260. Today's move brought price right into that first support band. If it holds, you get consolidation. If it breaks, you get acceleration. Those are the levels that matter. Everything else is commentary. Now let's address the psychology again, because psychology drives short-term volatility. After a sharp drop, retail traders often panic. Some sell immediately. Some wait and hope for a bounce. Some try to buy the dip too early. Meanwhile, larger players watch. They wait for the panic to peak. Then they decide whether to accumulate or push price lower again. The absence of massive panic selling in ETF flows suggests we haven't seen peak fear yet. That means volatility could continue as the market searches for equilibrium. But here's the nuance. Markets don't always need massive panic to bottom. Sometimes they bottom when selling pressure simply runs out. When there are no more sellers left at a given level, price stops falling. It stabilizes. Then it grinds higher. That kind of bottom is quieter, less dramatic, harder to spot in real time. We might be seeing the early stages of that kind of process, but we need more data to confirm. So what should you expect from the data over the next few sessions? Expect retests. Markets love retesting levels. If gold dropped to 2040 today, don't be surprised if it revisits that level or dips slightly below before deciding direction. Same with silver around 23. Retests are normal. They're part of the process. What matters is how price reacts on those retests. Does it bounce quickly? Does it linger? Does volume increase? Those reactions tell you whether buyers or sellers are in control. Also watch for divergence between price and volume. If price drops further but volume decreases, that suggests selling pressure is weakening. If price drops and volume increases, that suggests selling pressure is strengthening. Those signals help you determine whether the flush is ending or continuing. Another thing to watch is volatility itself. After a sharp drop, volatility often spikes and then gradually declines as the market stabilizes. If volatility remains elevated for several sessions, that suggests ongoing uncertainty and potential for further moves. If volatility drops quickly, that suggests the market is finding balance. So keep an eye on volatility indicators. They provide context for price action. Let's bring it back to today's numbers again to keep everything grounded. As of today, gold around 2040, silver around 2320. Sharp drops but not total collapse. Support zones being tested but not fully broken. Positioning shaken but not fully flushed. That's the situation. That's the data. That's what we're working with.
The key now is patience. The market will show its hand over the next few sessions. If buyers step in aggressively and push price back above key resistance levels, that suggests the flush is over and we could see recovery. If sellers return and push price below support with volume, that suggests more downside. Until one of those scenarios plays out, the most likely outcome is range-bound volatility as the market digests the move. This is where discipline separates professionals from amateurs. Professionals don't chase every move. They wait for confirmation. They watch levels. They watch volume. They watch positioning. They let the market prove itself. Amateurs react emotionally to every headline and every price tick, and that's how they get trapped. So what do we expect from the data right now? Expect continued testing of support around current levels. Expect volatility as the market searches for equilibrium. Expect macro headlines to influence short-term moves, but not necessarily change the overall structure immediately. Expect positioning adjustments as traders respond to the drop. And most importantly, expect the market to reveal its direction through price behavior around key levels. As of today, the reality remains simple. Gold near 2040, silver near 2320. A sharp drop that shook confidence but didn't destroy structure. Support zones directly below, resistance zones above. The next move will depend on how price behaves around these levels. That's what matters. That's what to watch. Everything else is noise.
What you watch now is simple. Watch how gold behaves around 2040. Watch if buyers step in around 2020. Watch if silver holds 23. Watch volume on any further drops. Watch open interest changes. Watch ETF flows over the next few sessions. Watch dollar and yield behavior around upcoming macro data releases. Because the next catalyst could either accelerate this flush or reverse it. As of today, the numbers are clear. Gold around 2040, silver around 2320, sharp drops on the day, support zones being tested, positioning being shaken, liquidity being probed. The next move will depend on how these levels respond to continued pressure or relief. That's the data. That's what matters. Everything else is noise.